Well, here we go. Chapter 1. Let's discuss the investment environment. As this course progresses, there's obviously many topics that we'll cover. As we get started here, we just want to discuss the world around us, right? What is it that we see out there? What are the assets that we're talking about in general? What is investing itself? So let's think about investment. Investment is a delayed consumption. That is, you're going to put some money somewhere because you don't want to spend it today. But when you place it in this other place, right? When you put these funds somewhere else, there is an expectation that there's going to be some compensation that you earn for this delayed consumption. That is what investment is. What is the difference between gambling and investing? The difference is that there's no expectation of a positive return from gambling. In fact, statistically, if you calculate the expected return of investing, of gambling, it has a negative expected return. So again, there is a difference. They are similar, but yet the outcomes are expected to be different. So we have real assets and financial assets. Real assets have some type of productive capability or capacity. Buildings, lands, machinery. Financial assets are claims on those assets. So if you kind of think about a real asset provides income for financial assets. So financial assets don't directly contribute to any productive process. We have basically two categories of financial assets: fixed income securities and equities. I think everybody is familiar with the differences between the two. All right, one is a lending component, and the other is an ownership piece. We will be introducing in this course some things that you may not have heard before, but may have. We're going to talk about derivatives, and a derivative derives its value, hence its name, from the value and prices of other assets, in particular from bonds, from stocks, from commodities, from currency. So a derivative is something that gets value from something else. There are other kinds of investments. We could invest in currency, right? This isn't cash itself, but this is actually investing in the currencies of another company and then trading based on the expected changes of those values of those currencies. Commodity futures is a contract, like where we can actually invest in things like oil, corn, cocoa, etc. We'll discuss this towards the end of this course, but these are, again, just additional kinds of investments that we can make in our strategy for gaining wealth. So what do the marketplace actually, what does it do for us, right? So the marketplace has an informational role, right? Capital flows to companies with the best prospects. Now, we have to decide what is meant by best and how do we measure best. That's the goal, that's the objective of an investor. We want to be able to time consumption, right? Investors and companies have future planned consumption strategies. So we need a mechanism to help us provide a process for planning that. We need to have ways to allocate risk. We need to have ways of absorbing risk and taking risks when we want. But we also need to have ways of reducing and minimizing risks when we need to do so. A question that we might have is, why should managers act against shareholder interest, right? So let's think about an owner first. Let's think about a sole proprietor. Would a sole proprietor do anything that would intentionally, negatively impact their wealth? And of course, the answer to that is no, right? A person would never do anything to intentionally hurt themselves. I mean, they can make mistakes, but that's not what we're talking about here. Whenever we move into other business forms, like a corporation, we are separating ownership and management. That creates what's referred to as agency problems. Managers might do things that are not coordinated with the desires of shareholders. And if they're not coordinated with shareholders' desires, another way of saying that is they will do things that cost shareholders wealth. It will impact the wealth of the owners of the company. And of course, the owners don't want that to happen. So how can we mitigate this? How can we create a situation where agency problems are not as relevant, right? They're not as impactful on the company and on shareholder wealth. If we can tie managers' income to the success of the firm through some form of compensation, we may be able to get them to think more like owners, right? If managers are owners, then they will work to increase their own wealth. So we can use things like stock options and some other alternative vehicles to put them in a place of ownership. We can have monitoring from our board of directors, right? This refers to the labor market. How many times can you be fired before it has an effect on your ability to get a job or to maintain your current salary? Right? If managers cannot do what shareholders want, they get fired, and that has an impact on future revenue. Maybe we could have some monitoring by large investors and security analysis, right? This has become much more important historically. Since the compensation of money managers is tied to the performance of investments, these managers are much more involved in watching the activity in the corporations. Again, they make money when the owners of the company make money. So they're going to be very diligent in making sure that management works the way they want them to work. And finally, just a takeover threat, right? This is a threat that comes from outside the company, right? Other investors see the company as being undervalued since management cannot maintain the stock price, and they're going to make a play for its assets, right? This happens frequently. When companies are taken over, typically the old management team is dismissed. So there's lots of ways that we can help get managers to think more like owners. If you think about corporate governance, right, we're really talking about who runs the company, right? Is corporate ethics real? Are corporate CEOs and CFOs, are they ethical people? If you look at some of the most recent news things, there have been lots of accounting scandals, right? Auditors are supposed to be watchdogs and helping us out, but that's had some flaws. Right? There's been some analyst scandals with respect to Arthur Andersen, etc. So in general, there are some issues, right? That corporate governance and the ethics of the corporate entity have not really turned out to be that effective. So what happens is when scandals happen, the government takes action. And this political action is always to an extreme, right? They always move from something bad happened and we're going to fix that. So they make a change that is extreme. And that extreme change has an impact on business. We refer to it as regulation. Regulation is not necessarily bad. The challenge is it is typically a knee-jerk reaction that really goes too far. Sarbanes-Oxley Act was an attempt to prevent future abuses. It looks at auditing techniques. It criminalizes misleading or fraudulent data. Essentially what it does, it attempts to increase the quality of information. What quality means is that you can trust the information. The information you see is relevant, it is material, and more importantly than anything else, it is truthful. So these are all aspects or things that the financial markets and the economy are dealing with on a daily basis. If we think about the investment process, we are essentially going to try to talk about creating portfolios. There are two terms we have to understand. One is referred to as asset allocation. This is where we choose amongst a broad asset classes. In general, we can break this down into two classes, stocks and bonds. Asset allocation would determine what percentage of stocks you own relative to the percentage of bonds that you earn. Research shows that this is the more important of the choices that you can make. In the course information that I've given you, there is an article about asset allocation and this process. I think it's kind of informative to read through. It's a little lengthy. It's about 10 to 14 pages long, but it gives you some insight into some research that was done that talks about the importance of asset allocation. The other piece is security selection. This is where we're choosing securities within the asset class. So we decide that we want 70% of our portfolio to be stocks. That's an asset allocation decision. But within that 70%, we have to figure out how do we fill that out. What securities are we going to buy? That is called security selection. There are a variety of tools that we can do with that with, and we'll talk about those as we work through the course. And of course, in this particular class, we'll also be playing a portfolio game, so you might be able to utilize some of those tools in playing that game. There are essentially two processes, if you will. We can do something called a top-down approach. We do asset allocation followed by security analysis. Essentially, we figure out the asset classes and then determine what investments are in each class. This, for me, makes a little bit more sense in a broad concept, if you will, of investment analysis. Unfortunately, most people don't have the funding that can follow that type of approach. Most people work through what's referred to as a bottom-up approach. They try to find investments based solely on price attractiveness. This finding these perceived good investments really doesn't pay any attention to asset class proportions. I think that is the way most people go about the process. From a statistical perspective, that might not be the best way to diversify one's holdings and to ultimately achieve a higher rate of return. What about the concept of risk and return? We will discuss this in pretty good detail over a couple of weeks. Higher risk assets are priced to offer higher expected returns. This risk is the compensation you get for delaying compensation or consumption. So if you kind of think about it, you can delay consumption by investing in the United States government, or you can delay consumption by investing in stocks. The uncertainty of those cash flows or that future consumption that you'll be able to experience, that's what risk is all about. So risk and expected return are positively correlated. We're going to try to answer these questions in this course. How do you measure risk, and how much premium should risk pay you when you are assuming risk? Another concept that we have to be concerned about is the concept of efficient markets. The question here is, when you see a stock price, how comfortable are you that that is a fair price? The efficient market hypothesis states that prices quickly adjust to all relevant information. If that is true, stocks in general should neither be underpriced or overpriced. So the question we need to ask in the end here is, how efficient is the market? If it is not totally, perfectly efficient, then we might be able to find nuggets of information to provide an advantage over other investors. Of course, we need to act quickly. We need to do research. All of these things are time consuming and require funds. So if you think about investing, right, there are really two ways we can go about this. We can invest in what's referred to as a passive management mode. We can purchase a highly diversified portfolio. We really have no attempt to find undervalued securities on an ongoing basis. We really make no attempt to try to time the market. And what this assumes is that we have a very efficient market. So whatever you purchase is fairly priced, so you shouldn't worry too much about it. It really is a buy and hold kind of strategy. In an active management process, we want to find mispriced securities. We're going to try to determine the best times to enter the market with those securities. So this assumes that there is some inefficiency within the marketplace and prices of securities. What we may find out is that active management is very difficult. So let's think about who the players are in the stock market or in capital markets in general, right? Who is it that has all of the extra funds? Well, in general, in the aggregate, it is the households of our economy that has the extra money. We have cash that we do not need currently. So we want to take that money and delay consumption today for the hopes of growth and wealth in the future. So then who is it that needs this money? Corporations and the government are the ones who are the net demanders of capital, right? They need money today to operate, to expand operations. They don't have the funds to do that. So they get that from those folks that supply capital. So who are the players in general? We have what are referred to as financial intermediaries. Essentially, what financial intermediaries do is they're in the environment, if you will, between the suppliers and demanders of funds. It's very difficult to connect all the individual people, those hundreds of millions of people that have extra money, and then those tens of thousands of companies that need it. How do those come together in a structured market environment? We need intermediaries to help guide us in that direction. What we will ultimately talk about then with respect to these intermediaries is a particular act that was repealed under the Clinton administration. The Glass-Steagall Act required, it was, I believe, from 1940, required, it demanded that most companies didn't combine themselves. I'm not saying that's very well, but essentially it said banks, insurance companies, and investment companies cannot be the same company. They must be separate and distinct entities. When the Glass-Steagall Act was repealed, it created the current environment, the current financial intermediary marketplace, if you will, which has extremely large companies. In fact, that's where the term too big to fail has come from. So this act required separation of entities. The repeal created the merger of entities. So now we have companies that if they misbehave, if you will, then they're so big it requires the government to help them so that the entire economy is not damaged. So that's part 1 of chapter 1. I'll see you in part 2.